Hi, welcome to Market Minute. So last week we had some really interesting economic indicators reported, and they're pointing towards a really weak economy, unfortunately. And then we think that Grail is a table pounding buy, and I'm going to walk you through kind of what we're thinking on it. Had a couple of conversations with the management team there, and then the dollar stores, Dollar General, Dollar Tree. Those are exceptional values down here. We're not buying them yet as the economy continues to weaken, but we think they're exceptional values in good little companies. And again, we'll explain our thought process around that as well. So the economic indicators, so we have two that we really like, which is the Beige Book, which is a survey of 12 different districts in the United States, and it gives us an update on how those districts are performing. And then the ISM Purchasing Managers Index, we think this is probably one of the best indicators out there for what's happening in the manufacturing sector, which is the cyclical part of the overall economy and can point to either coming into a recession or coming out of recession or overheating as well. So on September 18th, we believe that the Federal Reserve will cut rates by 25 basis points to start to bring down the federal funds rate closer to where the two-year Treasury is. So the spread is about 1.5%. So we think the federal funds rate will come down to about will decrease by 1.5% to around 4 to 3 3/4 in the next, say, 3 to 6 months. The Beige Book was for August of 2024, and in three of the districts, they showed growth. So 3 of the 12, they had growth. 9 of the districts either were flat or declined, versus only 5 of the districts in July that were flat to down. The employment levels were about flat, and consumer spending declined in most of the districts. Manufacturing activity was also down in most of the districts. So this is a very weak report. This is a really good economic indicator. It tells us a lot about what was happening around the United States. And frankly, it kind of concerns us a little bit that we are headed towards that recession. The ISM Manufacturing PMI, so this is a survey of purchasing managers around the country. They give feedback as to what's happening in their businesses. So it's a diffusion index, which means below 50, the manufacturing sector is declining. Above 50, it's expanding. It's been 50 or less now for 22 straight months, from November of 2022 to current, 22 straight months. So the manufacturing sector is not doing well, which is, again, the cyclical part of the overall economy. Generally, when the purchasing managers index gets to around 42, it's roughly 47 right now, but when it gets to 42, we're pretty much in a recession, and that's a great point to start, buying the stock market, buying stocks rather aggressively. At 42, that's a really good buy signal traditionally. And then at 60, it's a good sell point, which means the economy is overheating, and we had that back in 2021. So it was a good indicator of what was coming in 2022. So looking now at employment. So the employment report out Friday, last Friday, we don't give a lot of credence to that report because the error factor into the report. But if you simply look at the JOLTS report, which was reported last week as well, it shows the JOLTS report is the jobs openings and labor turnover survey. So it showed that there are approximately 7.7 million jobs that are open at this point. That's down from 12 million jobs that was open back in 2022 at the height. So currently, the unemployment rate is about 7.3 million. So that is starting to rise, and that's about equal. The people that are unemployed to the jobs that are open, that's about equal. So the jobs market is more or less in balance, maybe on the weak side, I would say. which should cool inflation. So labor wages will start to moderate and should cool inflation. So this is a good sign for the Federal Reserve to begin their long, probably cutting of, process. So consumer stocks. So, the stock market really tells you a lot. You can look at these two stocks. This is Dollar General, which peaked at $260 back in 2023. It's all the way down to $81. And Dollar Tree peaked at $173 back in 2022. It's down to about $63. So the dollar stores service primarily the lower income part of the market, but all sorts of different income brackets do shop at the stores. Dollar Tree gave a good explanation of what was happening in that from the low end to the high end consumer, everything is in terms of what they're purchasing much smaller in the amounts that they're purchasing. So these stocks are good little companies. So these are growth companies. They have good businesses. They're just in the wrong spot right now. And actually, probably the consumer is not. Consumer stocks are not a great place to invest at this point. Walmart's doing great, but generally speaking, the rest of retail is not. And if you look at Dollar General as an example, it's trading at 0.45 times revenues. Okay, so I'm not pointing to earnings. We're trying to get a picture of what the valuation of that company is, and the earnings are distorted now because the earnings are down. But if you look at revenues, 0.45 times. At the high here, it was roughly 1.6 times. So you can see there's considerable upside in Dollar General, as well as Dollar Tree. It peaked at 1.3 times. It's at 0.56 times. So both companies have about 3x upside to the current prices just to get back to where they were back a year or two ago. So we like both companies. We think they're probably bottoming out, but we still have more data points to get through. Probably a slowing economy in this quarter and into the fourth quarter. And it'll take a while for the Fed cutting rates to really reinvigorate the economy again. But these stocks are probably close to the bottom. Biotech. So before I forget, we'll be at a biotech conference in New York this week, and I wanted to invite all of our investors to let us know if they'd like an update on what we heard and some of the positions in our biotechnology strategy as well. So we had a few calls now with GRAIL, ticker symbol GRAL. This is the blood test that detects cancer early. They do it through the DNA that's left in the blood from the cancer, so they can detect it really early. So 50 different cancers they can detect. So we think over time there'll be 100 million people in the United States that'll probably take this test annually. So it's going through their approval process that's needed to get the insurance approval. So they need to get approved by the FDA, but it's already on the market. They're generating over 100 million in revenues already. But if you do the calculation on GRAIL, so if you look out, say 7 years, the test will probably be out there fully into the markets at that point. Could be into 100 million people taking the test annually. Now they're currently charging $1,000 for the test. We think it probably goes down to about $300 per test. If you discount that revenue back, 4 times that revenue is what we expect the stock to trade at. If you discount that back by 25% a year, you get a net present value of roughly $560. So the stock is currently around $13 or $14. It was spun out of Illumina. Okay, Illumina acquired GRAIL in August of 2021. They were forced to divest it June of this year. They lost the court case versus the government. The government claimed antitrust issues. Um, Illumina paid $280 roughly for Grail when they bought it in 2021. So the stock at roughly 14, in our opinion, it's a table pounding buy. We like this one a lot, and you'll see it in a lot of our different strategies. So again, if you like an update on this, let us know. We will actually put an update in Mark in a minute if we find anything really compelling into that next week. Um, Thank you very much. Please like, subscribe, come to my website, Patrick Adams CFA, and sign up for a hard copy of Market in a Minute. We are being defensive. Just keep that in mind. We're in September. We're being defensive. We're looking for more downside in the overall markets. Take care.